Investment mistakes can cost you money, and that's why you must try to avoid them. Successful investing is not just about selecting the right stocks. One must also avoid simple mistakes that might undo all the previous hard work. Even though the process may seem complicated or scary, it can be made easier and less risky by following best practices and being aware of common mistakes. In this video, we will explore the do's and don'ts of investing and highlight common mistakes to avoid. So make sure to subscribe to our channel and hit the bell icon to stay notified of future content. So let's start the video. Number 10. Don't follow the crowd. Following the crowd is a bad way to invest since it doesn't require study and just involves doing what other buyers are doing. Many people don't find out about a good investment until after it has done well in the past. If the price of a stock doubles or triples, the mass media usually calls that a hot take. Unfortunately, by the time the news comes out, the stock may have already hit its highest point. At that time, the investment is probably overpriced. But TV, newspapers, and the internet, including social media, can push stocks higher into excessively overvalued territory. Number 9. Don't expect good performance to continue forever. Another common mistake is relying on positive past performance or neglecting to monitor whether it continues year after year. In addition to considering historical performance as a risk indicator, one should also consider other metrics. For instance, certain stocks may surge or even double in value one year, but for a variety of reasons, this success is not a guarantee in the following year. A company with rapid growth may experience consecutive years of high profits due to the introduction of a competitive and unique product, but fail to innovate and introduce new products to the market in subsequent years. The objective should be to construct a portfolio with a long-term investment horizon, with an asset's historical performance functioning only as a risk indicator. Number 8. Don't wait to get even. Waiting to get even is another common error to avoid when investing internationally. Getting even involves holding a losing stock until it returns to its initial price before trading it. According to behavioral finance, neglecting to recognize a loss is called a cognitive error that results in double losses. First, by not selling the falling stock, which may continue to decline and lose value. Second, you are forfeiting an opportunity to invest that money in something better. If the answer to the question, "Would I buy that stock today?" is no, then you should not continue to hold it. Number 7. Don't lead with emotions. When you decide how to spend your money, several factors come into play. Relying on emotions in a volatile market is a common investment mistake. If you cannot wait a few days to acquire or sell a stock, you are likely making an emotional decision. As the saying goes, fear and greed run the market. On a shorter time frame, stock market returns can vary widely, but over the long term, historical returns tend to favor patient investors. An emotionally driven investor may see this type of negative return and sell in a frenzy when they would have likely been better off holding the investment for the long term. Investors who are patient may benefit from the irrational decisions of other investors. You should not make hasty investment decisions because you felt like it. Less emotional involvement in the market is preferable. Number 6. Don't invest everything you have. When the market is performing well and you see growth, it may be alluring to invest all or nearly all of your cash savings. However, bear in mind that market investments are for the long term. Ideally, you will not require those funds for many years. Keep some of your cash savings for quick needs and an emergency fund so you don't have to use your investments to pay for unexpected expenses. Avoid placing your financial security at risk by investing all of your savings. Let's move on to the proactive side of investing and look at the most important things you should do that can lead you toward financial success. Number 5. To diversify. Diverse investments that respond differentially to market conditions are essential for mitigating risk. When you place all of your financial assets in one basket, a single negative event could put at risk your entire portfolio and your financial future. Diversifying your portfolio reduces your risk so that if one of your investments underperforms, it will not inevitably hurt the entire portfolio. You can diversify across asset classes by investing in stocks, bonds, and real estate. If the stock market collapses, for instance, the bond market may perform well, reducing your equity losses. Investing in multiple firms within the same industry is another method to diversify. You can also purchase several sector funds, each of which concentrates on a particular industry, such as technology or finance. Number 4. Be patient. Successful long-term investing requires 1% action and 99% patience. The majority of investors make investments with a short-term outlook, particularly when investing in equity markets or mutual funds. The smallest fluctuations in returns can frequently dissuade investors from high-quality investments or induce them to sell their assets for short-term gains. This frequently causes them to lose out on the long-term benefits of investing for longer periods. To have a disciplined approach, you must disregard short-term volatility and concerns and focus on the long-term growth potential of the market. Number 3. Do strategize and follow a plan. The fundamental rule of stock trading is plan your trade and trade your plan. It is obvious that when trading stocks, one must have a comprehensive view of their investments. Without a trading system, it is impossible to regulate the market's fluctuations. As a novice investor, you should first have a plan. Emotions can run their course, and when money is involved, everything can become inherently overwhelming. For instance, if you choose to invest in individual stocks, value stocks, growth stocks, or index funds for capital growth, consider your risk tolerance, the amount of time you can devote to trading and investigation, and the amount you are willing to invest. Number 2. Do research and educate yourself. Before investing, investigate the potential investment opportunities in depth. Understand the company or asset's fundamentals, its financial health, and any market trends that may impact its performance. No one should underestimate the time, education, commitment, and dedication required to be a successful stock trader, let alone a stock trader. Getting a financial education and learning how basic accounting works can help you get a complete picture of investing and trading. How money works and how to make money work for you are not taught in schools, so failing to educate yourself beforehand is the number one mistake to avoid. In addition to perusing online sources or public company information, be prepared to educate yourself with investment books or stock trading books to gain a deeper understanding of investing and trading. You should not choose stocks based solely on whether you like or dislike a company. Number 1. Do investing early. Due to compounding interest, the younger you are, the greater your potential investment returns. Compounding means that your contributions earn interest on both the initial investment and the accumulated interest. The earlier you begin investing, the greater your prospective returns. If you are not currently investing, ask yourself why. Time is on your side, especially if you're early in your career. Start investing soon. And remember that even small payments to your retirement plan are better than none. If you are contemplating investing later in life, keep in mind that it is not too late to benefit, as investing your savings may help you at least combat inflation. Mistakes are part of the investing process. Knowing what they are, when you're committing them, and how to avoid them will help you succeed as an investor. We hope you found this video informative and enjoyable. Don't forget to give it a like, subscribe to our channel, and hit the bell icon to stay updated with more exciting content. Thanks for watching.